As of now, many people, including me, suggest investing in index funds. They've shown stellar returns since inception. Many see index funds as their retirement plan, especially when the US economy is stable. But here's the truth. Rich people don't just invest in index funds. They aim to multiply their wealth. They focus on building businesses, knowing that a 9-to-5 job won't make you filthy rich. When you work for someone, they profit while you earn a paycheck. Rich folks understand that investing in a business is a money multiplier. It takes time, but the first 10 years can create massive cash flow. By reinvesting profits and marketing, they expand their wealth exponentially. Instead of index funds, they invest in businesses, growing their wealth like no other. For most people, especially beginners, index funds are a low-cost, reliable way to build wealth over time. But for those looking to get wealthy faster, creating a business or investing in higher-risk ventures can multiply wealth beyond what index funds offer. Both strategies have their place in a diversified wealth plan. You might blend steady index fund investing with entrepreneurial ventures based on your goals and risk appetite. Want more insights on blending these strategies or evaluating risks? Let me know.
Index funds. People everywhere are talking about index funds. Many suggest you invest in them, and for good reason. These funds have given incredible returns since they started. This makes them a top choice for building a strong financial future. Many folks now see index funds as their main retirement plan. They offer a simple way to grow your money over time. This approach, known as passive investing, lets your money work for you with less effort. It truly simplifies long-term wealth building.
Understanding index funds, what they are and how they work. What is an index fund? An index fund is a type of investment that tracks a specific market index. Think of it like a mirror for a group of stocks or bonds. For example, an S&P 500 index fund holds stocks from the 500 largest US companies. It simply aims to match the performance of that index, not beat it. The mechanics of passive investing. Passive investing means buying investments and holding onto them for a long time. Index funds do just this, unlike active investing where managers constantly buy and sell stocks. With an index fund, you own a piece of every company in the index. This hands-off approach makes investing easy for anyone. Key benefits of index fund investing. Index funds bring many perks to the table. They offer instant diversification across many companies, which spreads out your risk. Their costs are very low, helping your money grow more. Plus, they aim to match the market's returns, giving you solid growth without the guesswork. The stellar performance of index funds, a historical perspective. Long-term growth trajectories. Major market indices have shown steady growth over many decades. For example, the S&P 500 has averaged about 10% each year over the last 50 years. This consistent rise proves the power of staying invested for the long haul. It helps your money build up significantly over time. Outperforming actively managed funds. Did you know most actively managed funds actually fail to beat their benchmark index? Year after year, studies show that professional stock pickers struggle to keep up. Index funds, by simply tracking the market, often do better than these high-cost funds. They provide market returns without the extra fees or stress. Real-world examples of index fund success. Countless people have used index funds to build large nest eggs for retirement. Families who started investing small amounts regularly saw their savings multiply over decades. This simple strategy has helped many reach their financial goals. It proves consistency with index funds really pays off. Index funds as a retirement cornerstone, building your future. Diversification made simple. Investing in an index fund gives you instant diversification. Instead of picking individual stocks, you own a tiny slice of hundreds or even thousands of companies. This spreads your money across different industries and sectors. It lessens the chance of any single company hurting your overall savings. Low costs, high impact. Index funds come with incredibly low costs, often called expense ratios. While actively managed funds might charge 0.5% to 1.5% or more yearly, Index funds can be as low as 0.03%. These small savings compound over many years. This means more of your money stays invested and grows for you. Tax efficiency. Index funds are also tax-efficient investments. Since they don't trade stocks often, they usually have fewer capital gains distributions. This means you might pay less in taxes each year compared to actively managed funds. It lets your money grow faster without yearly tax drag. Choosing the right index funds for your portfolio. Identifying your investment goals. Before picking funds, think about your retirement timeline and how much risk you're okay with. Are you planning to retire in 10 years or 30? Do big market swings make you nervous? Knowing your goals helps you choose the right mix of index funds. Popular index funds and what they track. Many popular index funds track broad markets. Funds like VOO or SPY follow the S&P 500, giving you exposure to large US companies. Other funds track the total US stock market or international markets. You can also find bond index funds to add stability. Where to invest, brokerage accounts and retirement plans. You can hold index funds in various accounts. Employer-sponsored plans like a 401 are common options. Individual retirement accounts, both Roth and traditional, are also excellent choices. For money outside of retirement, you can use a regular taxable brokerage account. Actionable steps: investing in index funds today.
Opening an investment account is simple. Many online brokers allow you to set one up in minutes. If your job offers a 401k, sign up and pick index funds from their list. Getting started is the most important first step. Determining your investment amount and strategy. Decide how much you can invest regularly. Many people use a strategy called dollar cost averaging. This means you invest a fixed amount of money at regular times, like every payday. It helps smooth out market ups and downs. Setting up automatic recurring investments is an easy way to stay consistent. Rebalancing and monitoring. The beauty of index funds is their simplicity. You generally don't need to rebalance them often, especially if you stick to broad market funds. Just make sure your money goes into the funds you picked. The goal is to stay invested and let time do the heavy lifting, your path to stellar retirement returns. Index funds have a proven track record, offering a simple way to build real wealth. Their low costs, broad diversification, and consistent market returns make them truly powerful. They provide a solid foundation for any retirement plan. Investing in index funds offers a simple, low-cost, and effective strategy. It gives you a robust plan for building your retirement savings. Take action today and stay disciplined with your investment strategy. Your future self will thank you for it. Index funds, a solid, reliable option for most investors. Consistent long-term returns. Index funds, like those tracking the S&P 500 or NSE Nifty, have historically delivered solid returns over the long term, often averaging 7 to 12% annually, depending on the market and specific index. They provide broad market exposure, diversification, and low fees, making them an excellent choice for retirement savings and long-term wealth accumulation for the average investor. Low risk and passive management. Because index funds are passively managed, they avoid the risks associated with active stock picking and market timing. This makes them less volatile and more predictable over time. Accessibility. Index funds are easy for most investors to access and understand, making them ideal for people who want steady growth without needing to spend lots of time managing investments. Why wealthy people often avoid relying only on index funds. Aim for exponential wealth. While index funds typically track average market returns, wealthy individuals often seek exponential growth. Building a highly successful business or investing in early-stage companies can deliver returns far beyond what index funds can provide, albeit with much higher risk. Building ownership, not just financial assets. Working a 9-to-5 job or investing passively typically limits wealth accumulation.
Business ownership creates cash flow and equity, enabling expansion, reinvestment, and ultimately wealth that can outpace traditional investment returns.
And time horizon. Wealthy investors usually have higher risk tolerance and longer investment horizons, allowing them to invest in riskier, but potentially much more rewarding assets like startups, real estate development, or private equity. An active wealth multiplication, entrepreneurs reinvest profits, innovate products, services, and scale operations, which are active ways to multiply wealth, not just relying on market appreciation. Balancing both approaches it's important to realize that index funds and business ownership investment are not mutually exclusive. Successful entrepreneurs often keep a portion of their wealth in diversified index funds for stability and liquidity, while using other capital to build or invest in businesses. And for most people, starting with index funds is a practical and wise approach to build foundational wealth. For those with entrepreneurial drive and capital, investing in or building businesses is a potential pathway to much greater wealth, but with commensurate effort, risk, and skill. Summary: and for most people, especially beginners or those with less time and expertise, index funds are a low-cost, reliable way to build wealth over time. And for wealthy people or those seeking to become wealthy faster, leveraging business creation or investing in higher risk, higher reward ventures can multiply wealth beyond what index funds typically offer. Both approaches have their place, and a diversified wealth strategy might combine safe, steady index fund investing with entrepreneurial or active business investments depending on the individual's goals, resources, and risk appetite. If you want, I can provide more insights on how to approach blending these strategies, or how to evaluate risks and opportunities in business investments versus index funds.